In 1980, Max acquired 100 shares in Maycard Proprietary Limited. These were all the ordinary shares in the company. In 1987, Maycard issued redeemable preference shares to Max's wife Isabel and their 3 children. The redeemable preference shares entitled the shareholders to dividends payable at the discretion of the directors. The shares could be redeemed at any time by the company. The directors are Max and Isabel. The company carries on a card printing business, and in 2013 it had a turnover of $12 million and pre-tax profits of $3 million. The company has retained earnings of nearly $10 million. Max is now 73 and wants to retire. He wants to pass majority ownership of the company to his children and retain 25% of the ordinary shares. Max consults his accountant and is advised to redeem the redeemable preference shares for their face value and then, at a later time, to issue new ordinary shares. Each child will receive 100 ordinary shares. The subscription price for each of the shares is $1 each. What are the tax implications for the individuals involved? Max is in effect transferring 75% of the ownership of the company to his children. The shares being issued to the children are being issued at a very significant discount. The company could be worth in the order of $20 million, and the children are paying $300 in order to receive that value. This is an example of the precise situation to which the direct value shifting rules can apply. The first issue we will consider is whether the redemption of the redeemable preference shares has any implications under the direct value shifting provisions. In summary, there are no implications. The rights attaching to these shares are the right to be considered for a discretionary dividend payment. On one view, when these shares are redeemed, this would increase the value of the ordinary shares because in considering whether to pay dividends on the ordinary shares, the directors would no longer have the distraction of the redeemable preference shares. Whether this view is correct is open to debate. Even if it is, there will be no impact under the direct value shifting rules. This is because when the shares are redeemed, there are no affected owners of down interests. The remaining shares owned by Max will, if anything, increase in value. The next issue we will consider is what impact the direct value shifting rules have with regard to the issue of the shares to the 3 children. The conditions necessary for the direct value shifting rules to have operation have been passed. These tests are 1. The controlling entity test. This has been passed because Max owned more than 50% of the company when the scheme was commenced. 2. Who caused the value shift? This test has been passed because the controller, being Max, and an associate of Max, being Isabel, caused the direct value shift to occur. This is because Max and Isabel are the directors of the company. 3. The affected owner of a down interest test. This has been passed because the shares owned by Max, who is a controller, have decreased in value, and the decrease in value is reasonably attributable to the things done under the scheme. 4. The affected owner of an up interest test. Before this test can be passed, there must first be at least one affected owner of a down interest. That is the case here. Secondly, there is an up interest that is owned by an associate of the controller. It will also be noted that the de minimis rule does not have application, as the sum of the decreases in the market value of all down interests far exceeds $150,000. Given that the shares Max owns are pre-CGT assets, the new shares are obviously post-CGT assets, and there is a significant shift in value from one to the other. Is there any gain to be taxed? All of the preconditions necessary for there to be a taxable gain are present. There are down interests owned by Max that have pre-shift gains, and there are up interests owned by other affected owners, being the 3 children. This would normally cause CGT event K8 to operate in respect of the down interests. However, this CGT event has a specific exclusion in relation to pre-CGT assets. Accordingly, Max will not have a taxable gain. Despite there being no capital gain, the direct value shifting provisions will still operate in relation to the up interests with respect to the cost base. The cost base of the newly issued shares will be uplifted by the decrease in the market value of the shares owned by Max. So, the 100 ordinary shares owned by each child will be uplifted by approximately $5 million.